The money you make is a symbol of the value you create.
I would want to pick up though on the CBDC point for foreign exchange. Maybe two remarks. One about the central banks working together. I'm completely with Angus on that one. I would also like to point out that we're moving into a world where it's not getting easier for central banks to move together. We're getting into a geopolitically fragmented world where there's deep suspicion, I think, between countries, and I can only name the US versus China as an example. There's deep suspicion about each other's CBDC programs and how it's going to be used. So for them to provide a common rails, I'm not sure that's very likely. So it may happen within blocks.
Common rails are unlikely. As we saw with the TikTok ban in the US or the Great Firewall of China, Western and Eastern technology is often scrutinized, and for good reason. Facebook is an example of how trust was compromised. When we move to an internet of value, how will countries trust technology that is specifically for money? This is even more of a sensitive issue than data. This is where crypto comes into play. Crypto are protocols for money that are trustless and open source. Anyone can examine the code. Everything is auditable. Everything is settled with finality. There is little room to cheat the system. Some cryptos have different weaknesses than others, and we know that the IMF is not in favor of proof of work or proof of stake.
Would be.
How much adoption do you need before you feel secure that RippleNet is here to stay?
No, we are secure already. I don't think there is any question around that. But again, I've come to my original point, what we started with. Payments is a fragmented business. So I don't think globally anybody in the world has got more than 1% by transaction volume in terms of market share, right? I mean, and this is, I'm talking about very, very big players, right? So it will take some time for that consolidation to happen. And when I say consolidation, is positively, right? For people to join the network, to be on the node. So the only network of significant scale, for example, at least in cross-border, is SWIFT. But we all know SWIFT is outdated technology. For the newer technologies to take off, it will take some time for that ecosystem to become bigger.
Navin Gupta, ex-HSBC and Citibank, is telling you that Ripple is secure today. Every company that is building solutions around cross-border payments are only 1%, except for SWIFT, and SWIFT is antiquated technology. When SWIFT customers are paying high fees for slow payments, why would they stay with SWIFT? When this exodus from SWIFT happens, the 1% is positioned to absorb the 99%.
I think one thing when we think about a common platform, it's a little bit of a misnomer, and unfortunately we're working through the taxonomies of these systems. So it's nice to see where the gaps are and how we can update them. But we need to remind ourselves that this common platform is a distributed common platform, and that's super, super important. So when we think about, so we mentioned Project Dunbar, you mentioned Jura, and you mentioned Helvetia. There's also Project Enbridge coming out of Hong Kong as well, which is very similar to Project Dunbar, a little bit of a different participation arrangement. But what we're starting to see is if you can have a common settlement layer, right? If you can just ensure that settlement happens on the platform, then you can open up and just as thin a layer as possible on a common platform, and then everything else modularized to jurisdictions and currency types. There is a fighting chance that something like that can scale. Now, it's really interesting to think about how this scales. One common thing when you look at these platform arrangements is, Jura and Helvetia, both with Switzerland and France, are there's only 2 jurisdictions on that platform, but then when you think of Dunbar and Enbridge, we have 4 central banks and 4 jurisdictions, and 4 is kind of a sweet spot because you get the scale of kind of a multi-jurisdictional project, but you don't have to deal with governance and legal issues that are beyond that kind of extend out of the scope of what is possible. So I think once we get a handle on what are the commonalities and how can we run a system that works for 4 different jurisdictions, I think then we can start tackling the question of, do these things converge to a wider system that's adopted? Do they need to converge? Or is there maybe kind of a sweet spot around certain economic zones that can be the primary common system, and then at some point these things can kind of roll up into another system that maybe looks at it from a little bit of a higher level, like central bank liquidity lines and things like like that. To answer your question, maybe a little bit about the FX, will CBDC have an impact on the FX quoting, FX markets, and things like that? I think the answer is that it absolutely will. And my hope is that we'll be able to start to see corridors and currency pairs that don't exist today, and maybe liquidity in those pairs and business models around that simply haven't happened to date, because of the fundamental technology really hasn't been there.
Daniel Eden is former R3 that is now working for the BIS Innovation Hub. He debates the ex-bankers by telling them that distributed common platforms is very different than a centralized common platforms. He talks about the BIS projects and explains that they are walled gardens of trust. Having these faster payments or CBDC projects with countries that trust each other will bring an economic boost locally, but the same problems will exist when you leave these smaller networks. A common platform that is trustless is needed for the whole world to benefit from this technology. Inflation, supply chain, trust in voting, trust in food safety, carbon credits, currency manipulation, trust in foreign aid, the list goes on and on. This tech solves these problems and can restore trust.
100%, right? So firstly, almost majority of the banks, and I just want to be very open, are using the messaging layer of the Ripple net, right? Where they're essentially communicating with A and B in a super efficient manner. And that is scaling up, right? Banks are using us more and more across more corridors, right? So for example, they may start with corridor in India, then they say, hey, you know what, I want to use you in corridor in Pakistan, in Morocco, and in lots in the US, and in multiple countries around the world. And primarily they were using Swift earlier, and they start to use RippleNet because this essentially allows them in terms of standardized API capability between two institutions, right?
The banks on RippleNet are expanding to new jurisdictions. As more banks benefit and reap the rewards of a better technology, they venture out to the other products that could save them even more.
So I don't know. The time will tell. That's the honest answer, because it's been quite some time. That the decision is with the courts currently, and of course, both sides are arguing their points of view, right? But what I would say is actually on the ground, there has been no difference to our business. In fact, our business is growing leaps and bounds. So like, for example, just in Q1, Brad talked about it, we have grown 8x year on year. The adoption is great. The institutions, particularly outside of the US, want this solution because their consumers need it, their companies need it. We are seeing a lot of traction across the world in terms of this building out nodes and real volume essentially flowing through the nodes. We already are on a $15 billion run rate, right? And to my mind, that's amazing. And sky's the limit in terms of where we are headed.
Very quickly on this, but it's not uniform in that you could make that same statement across many of the continents. What we do know anecdotally is in the last year, volume on the network that we have set up has gone from less than 5% done in digital assets or in crypto or using XRP to now just close to 50%. The uptake has been enormous, and it's been in places like the Middle East and Asia where adoption has been quite quick.
When the Fed tightens, the dollar goes on a bull run. This creates a lot of problems in the rest of the world. The rest of the world has to pay for more expensive dollars. The correspondent banking network in smaller economies is taking on tremendous amounts of risk. Imagine if you were a bank that was holding on to Turkish lira before it inflated. This is where the high fees are coming into play. There is way too much risk in the system, so they can simply close up shop. This is called de-risking. Ripple can bypass this whole system and the amount of risk by using ODL. Navin Gupta said business has boomed, and with good reason.
Is there a sense here that the regulators actually wouldn't mind getting rid of correspondent banks altogether from cross-border payments in the long run? Angus. Then Gottfried, sure has some thoughts.
Yeah. I think there is a role to play for multiple parties in this landscape. In certain markets, I think it makes absolute sense to have correspondent banking relationships. There are more risky markets that, frankly, some of the larger markets would not want directly connected into their own, into their own broader markets based on the fact that it could create financial stability risk issues, for example, for them directly. And they are probably quite comfortable that certain commercial banks take the risk and price in the risk associated with those particular markets. But I come back to, the point I made earlier, which is it's also about, for me, it's about what is the purpose of what you're using a cross-border payment for. And I think on that basis, what's really important there is, again, what's the right solution for that? If the intention, say for wholesale payments is to improve your liquidity, to reduce your costs, to improve your settlement risk by reducing down settlement time frames, and to increase your options to be able to link, for example, delivery versus payment transactions with cross-currency swaps intraday. The correspondent market doesn't suit that very well. Let's be clear, and other solutions in the market are going to. So I'm not convinced that central banks necessarily want to remove correspondent relationships entirely from every single flow. I think it's around, where does it make sense to remove them, for what purpose?
It makes sense to remove correspondents in smaller economies or high-risk areas. ODL is taking a bottoms-up approach targeting banks and FIs for ODL adoption. As this network scales, it's going to prove itself. While the euro to dollar correspondent relationships are a while away, currency conversion in the rest of the developing world will benefit paired to XRP. The US dollar to euro will need to connect to this system to gain access to developing currencies for trade. This is going to force the correspondents to have competitive fees and speed.
Yeah, so it depends upon which side you are at. So if you're a sending institution, you're keeping those nostro accounts. So for example, let's say it's a bank X in Hong Kong. It's keeping 10 million US dollars in Philippines at the local bank account. The money actually belongs to the depositors. The money actually belongs to the shareholders of that particular bank, assuming that they're funded through equity, right? So as a sending bank or a sending institution or a sending central bank country, you don't like the risk of billions of dollars essentially stuck in local currency, which today is prone to multiple other things, right? So ideally, as a sending institution, you would want that amount to be zero, right? But also at the same time, you don't want to reduce or remove the customer comfort that comes with it in terms of being able to instantly settle, right? And a digital asset essentially allows you to do that. You can have zero money tied in your Nostro and Vostro accounts, but also at the same time settle 24/7, 365 days a year, 12 o'clock in the night, so that money can essentially move, right? But if you're a receiving institution, what you're saying is correct, right? The receiving institution used to have free float. Now that free float essentially would go away, but for the betterment of the overall system, because now the risk is lower. Let's assume, hypothetically, I'm taking an extreme example, you were Zimbabwe as a country or a Venezuela as a country, then you don't want those billions of dollars to be in the Nostro accounts because you're putting the depositors' money at risk from the sending institution.
So this is a correspondent banking landscape. This is from the BIS. You can see here, it says the value of correspondent payments has gone up. The volume of payments, so that's gone up. So there's more payments happening. While the number of active correspondents is dropping, the number of corridors is dropping. So they're dropping out of all these smaller countries, but the amount of money that's moving through them is going up at the same time. You can see the same thing here. The active correspondents are in the negative. They're declining all over the globe. The number of corridors is also are less connected. So this is a trend that's happening. And here's an interactive map of the number of correspondents. You see the red and pink areas are in some type of trouble, right? These correspondents are backing out of these jurisdictions. While you go to the number of payments, the whole world is still using a massive amount of payments, and then there's less banks that are even able to move the money. So for these areas that have less correspondence, their fees are going to go up tremendously, and at a time where the dollar is getting stronger and national currencies are inflating and hyperinflating. It's just a recipe for problems. And that's not what the whole global economy runs smoothly because everybody's involved. You're able to buy cheap natural resources from countries that have been de-risked. You're able to buy cheap labor from countries that have been de-risked. So if they can't get money, they're not going to provide any of their goods and services, and that's going to hurt everybody. So it's in everyone's best interest if these countries get money to them. And if the correspondents are going away, they're going to need technology to do that. XRP is situated just so to be liquid in a lot of these currencies. So that with XRP ODL, you're able to completely bypass this correspondent banking model. You're able to leapfrog it. And, the dollar to euro is probably not going away anytime soon. However, if you have this whole network of illiquid currencies paired to XRP, the dollar and the euro has to be tied to that in order to move money into that system. So if the U.S. wants to do trade with some of these smaller countries, then they're going to have to use ODL to get to there.
I wanted to make a point about the correspondent banking model stuff. There's a great BIS paper. I'll do a shameless plug for a BIS paper called "The Retreat of Correspondent Banking." And I think, at a high level, basically what the paper shows is that when you look at the world map and you look at the number of correspondent banking relationships, they are decreasing. And when you look at the number of flows, the value of flows that are going through those relationships, they primarily are also decreasing. And it's largely a process of de-risking. And if you zoom out far enough, you realize that the cross-border correspondent banking model at the end of the day is a private sector, commercially motivated business. And the question for central banks is really, is that okay? Is that okay? Is that okay to rely on the private sector and commercial motivated incentives to connect currencies cross-border? And that's an open question, and I don't have the answer, and the answer may vary by region. You mentioned two building blocks. You mentioned building block 13, interlinking payment systems, and you mentioned another building block about
17,
new FMIs,
yeah. Mm-hmm.
17. I think I just wanted to emphasize that when you look at, for example, interlinking payment systems, one of the projects that's going on in the Innovation Hub is called Project Nexus, where we're interlinking two different payment systems. And yesterday, I sat down with Sukmendu from the MAS, and he was talking about interlinking between Prompt Pay and Pay Now in Singapore and Thailand. And he was talking about the process, and he said it took 3 years to connect two faster payment systems. Now they're trying to connect to another one, and their target is about 6 months. But the idea here of connecting faster payment systems, well, first of all, it's a wonderful idea, but it actually, Project Nexus tries to tackle the problem of how to do them in a way that actually scales. But connecting faster payment systems doesn't relieve the clearing and settling underneath them. So actually, correspondent banking models and interlinking payment systems are not at odds with each other at all. Okay, it is just a messaging layer when you think about interlinking payment systems. That is not the case for 17. 17 new FMIs that cut across borders. That indeed is to some degree at odds with correspondent banking. Maybe when you look at financial stability, for good reason.
CBDCs. The concept of CBDCs is that instead of transactions clearing through your wallet, in the form of cash, or clearing through your bank in the form of when you go and you use your Amex card or your Visa card, all of your transactions are now going to transact through the Federal Reserve. And so every single thing you buy will now be seen by the government. And that'll be used in all kinds of ways. Now, we could speculate what those are, but as Brooke says, we don't have to because China's already done it. So we know exactly how this works. Here's how the movie plays. Okay, and I'll tell you this from real life experience. So I used to be on a committee called the International Heads of Supervision. It was the banking regulators of the G20 countries. And so one of my colleagues on the International Heads of Supervision group was the vice chairman of the People's Bank of China. And we had conversations about what China's intentions were and experiences were with their CBDC. The vice chairman of the People's Bank of China said that China walked down this road for 3 reasons, and tell me if you like any of these reasons, okay? Reason number 1 is with a CBDC, we will build our own network that will be entirely away from the global financial network administered by the US through something called the Basel Committee. And once we do that, the US will not be able to sanction us anymore because we'll have our own system. And we can be in it with anybody we want. It could be Russia, North Korea, Cuba, Venezuela, or whatever, but it'll be free from sanctions because it doesn't run through the banking system. That's reason number one. Reason number two, because our economy is such a fast-growing and large economy, we will be able to supplant the dollar as the world's global reserve currency. And the way we will do that is once our CBDC is fully operational, we will require inbound investment into China to be made not in dollars as it is today, but in ECNY tokens. That's the name of their CBDC. So if I'm a US investor and I want to invest in WeChat or Alibaba, I can no longer write a check in dollars. I have to first go and remit it in that form. And the third reason is because we want to approve and disapprove transactions for our citizens. There's some things we think some people shouldn't buy, and we want to be able to turn it off. Much as China recently used their COVID health app to shut down a series of protests by turning it red, right? They want to be able, when you are the bad guy in the Tiananmen Square protest, to turn off your wallet and not allow you to spend your own money. So these are things that I'm not making up. They've happened in the only country to launch a CBDC thus far. I don't think anybody thinks any of those are good things, right? And you're probably thinking, well, that'll never happen here because it's America. But I'm here to tell you, as your former banking regulator, that the only reason that America is any different is because we don't build those kinds of things. We are, after all, just human beings. And once we make it possible to do those things, you're crazy if you think that some generation of leaders in whatever administration you disagree with won't do that.
I watched a conference with Christian Carlo, and he was talking about the Fed coin. One of the participants was literally yelling at him at the idea of a Fed coin and the power that the US government would have with a Fed coin. So I think this is going to be very unlikely for the US to actually develop the Fed coin. What's more likely in my mind is that we'll see incumbents adopt protocols, and then the Fed issues dollars directly onto that protocol, similar to what Palau did with their US dollar, right? So the US dollar became an IOU on the XRP ledger. You can either look at the problems you come across as opportunities or concede to being defeated by them. Either way, the choice is yours. Thanks everyone, I hope you enjoyed the show. Please take a moment to like and subscribe. If you're interested in supporting my channel, I have a Patreon at patreon.com/fame21more.